You can still pull the ownership trail from most successful real estate investors and business owners in about 30 seconds through county recorder searches, Secretary of State filings, and commercial data aggregators. Their properties, entities, and sometimes linked addresses surface quickly. When privacy surfaces in conversation, the common suggestion is to just use a land trust. That advice is incomplete. It rarely addresses where the legal boundaries sit, how funding mechanics interact with existing mortgages, or what happens when the structure meets real-world scrutiny from lenders, courts, or counterparties. There is a material difference between limiting unnecessary public exposure and attempting to create secrecy from parties entitled to that information. Crossing that line does not protect wealth. It creates discoverable inconsistencies that can undermine the very protection sought. In this video, I break down how legitimate privacy layering functions in 2026, land trusts, nominee trustees, holding companies, and the operational realities that determine whether those layers hold. The objective is to make it materially harder for competitors, tenants, former spouses, litigants, and data brokers to assemble a complete map of your holding while preserving full compliance with tax reporting, lending covenants, and core obligations. I'm John Conrad, forensic accountant and founder of Numeratus.us. We provide white-glove, concierge accounting for ambitious entrepreneurs and high-net-worth clients who need structures that survive examination and support capital preservation. Let's get into it. The persistent misconception is that meaningful privacy is no longer possible. In 2026, the picture is more precise. Full anonymity from every interested party never existed and still does not. What changed is the mandatory federal channel for domestic beneficial ownership information. Following the 2025 regulatory revisions, most U.S. domestic entities are no longer required to file routine beneficial ownership reports with FinCEN under the Corporate Transparency Act. That removes one automatic disclosure obligation that previously applied to LLCs, corporations, and similar entities. Banks and financial institutions continue to collect beneficial ownership and control information under Know Your Customer and customer due diligence rules. They respond to lawful subpoenas and court orders. The IRS receives ownership and financial information through tax returns, information reporting, and enforcement processes. Public records have not changed. Deeds, entity formation documents, listing managers or officers, and commercial data services still make it straightforward to connect names to assets and assets to each other. The practical implication is that privacy from the federal government in the form of routine beneficial ownership filings is no longer the central constraint for domestic structures. The constraint that remains, and that matters for capital preservation, is uncontrolled public exposure. When competitors, opposing counsel, or data brokers can assemble your portfolio in minutes, they gain information asymmetry. That asymmetry affects negotiation leverage, settlement positioning, and the speed at which your personal or business pressure can be applied. Smart privacy therefore focuses on what still appears in public indexes and casual searches, breaking the direct name to asset link where legally available, adding distance through holding layers, and ensuring operational consistency so that the structure does not create its own contradictions. Legitimate privacy in 2026 is not about eliminating every information trail. It's about deliberately increasing the cost and time required for outsiders to reconstruct your holdings while meeting every affirmative obligation that still exists. Tax reporting, lending requirements, and responses to lawful processes. That distinction determines whether the structure preserves optionality or eventually creates new vulnerabilities. A land trust places legal title in the name of a trustee while the beneficial interest remains private under the trust agreement. The public deed record shows only the trustee. In states with statutory land trust provisions, the framework has clear legislative support. In other states, the arrangement rests on contract. The distinction becomes relevant if the trust is ever tested in litigation. Courts examine whether the form was respected and whether the trustee functioned as such. The trustee named on the recorded deed is ordinarily not the beneficiary. That separation is the source of the privacy benefit. The beneficiary retains direction rights through the private trust agreement, but those directions do not appear in public records. A land trust by itself does not deliver asset protection. If a beneficiary faces personal liability, courts can look through the trust to reach the beneficial interest. This is why land trusts are routinely paired with LLCs or other liability shielding entities that sit between the individual and the trust. Funding mechanics carry direct consequences. Transferring mortgage property into a land trust generally qualifies for the Saint Germain exemption when the borrower remains a beneficiary and the transfer does not alter occupancy rights. When those conditions are not met, or when documentation is incomplete, the lender may treat the transfer as triggering a due on sale clause. The result is often forced refinancing on less favorable terms or an accelerated repayment demand, immediate capital and liquidity impacts. Land trusts remain a functioning tool for delinking public title from beneficiary ownership, but the protection is only as durable as the documentation, trustee selection, and funding execution. When executed correctly, the structure reduces the ease with which public records reveal the full scope of holdings. When executed loosely, it creates inconsistencies that opposing parties can exploit and may impose direct financing costs. Privacy layers only deliver value when the supporting records and operations remain consistent with the legal form. At Numeratus.us, we help clients implement privacy structures that align with tax positions, lending requirements, and operational realities. Clean books prevent commingling that would otherwise collapse the separation between entities and individuals. The nominee trustee or manager appears on public documents in place of the beneficial party. Holding companies insert an additional ownership layer between the individual and operating assets or real estate. The nominee must exercise actual fiduciary responsibility. When the nominee functions merely as a name on filings while the decisions and economic benefits flow elsewhere without documentation, the arrangement is vulnerable to challenge as lacking substance. In discovery or examination, the inconsistencies between public filings and internal reality becomes evidence rather than protection. Holding companies create distance in the ownership chain. Public records may show that a holding entity owns subsidiaries or properties, but without the full organizational chart, the complete economic map requires more effort to assemble. That added friction preserves negotiation timing and reduces casual intelligence gathering by counterparties. Series LLCs are available in a growing number of states, including Florida, effective July 2026. Each series can isolate assets and liabilities internally. However, recognition of the inter-series shield is not uniform across jurisdictions. Non-series states and federal bankruptcy courts have limited precedent, and outcomes remain uncertain when assets or operations cross state lines. Using series structures for privacy or liability separation without accounting for these recognition risks can leave the portfolio more exposed than a conventional multi-entity structure. Every layer must serve a documented business, estate, or financing purpose. Courts and regulators routinely disregard arrangements whose sole apparent function is concealment. When that occurs, structure that was intended to limit exposure instead becomes a focal point for expanded discovery and potential sanctions. Nominee and holding structures create meaningful separation in public view only when the nominee holds genuine authority and each entity has a substantive purpose beyond obscuring ownership. Otherwise, the layers add complexity without durable protection and can convert privacy efforts into compliance liabilities. Structures erode most often through day-to-day operations rather than defects in the governing documents. With the 2025 suspension of routine domestic beneficial ownership reporting, most U.S. entities no longer file BOI reports with FinCEN. This narrows one mandatory disclosure channel. Banks, however, continue to identify and verify beneficial owners and control persons under KYC and AML frameworks. They maintain those records and produce them in response to subpoenas or regulatory requests. Tax reporting has not changed in kind. Entity returns, K-1s, and applicable information returns disclose ownership and financial flows to the IRS. When privacy structures produce tax positions that conflict with public filings or operational signatures, the inconsistency creates examination risks. Vendor and service contracts are frequent leakage points. When leases, service agreements, or purchases are executed in personal names or paid with personal cards, direct connections form between the individual and the asset or entity. Data brokers aggregate these public and commercial records into searchable profiles that opposing parties routinely purchase. Banking relationships add another layer. Even when the account is in an entity name, the institution's file typically identifies the principals and control persons. Significant activity or inconsistencies trigger internal review. The operational reality is that privacy depends on alignment across every point of external contact. With fewer routine federal ownership filings required, the remaining visible channels, bank files, tax returns, contracts, and public records carry greater weight. Inconsistent execution in any of these areas can convert a protective structure into a liability precisely when capital preservation and strategic positioning are most important. This is the point at which precision matters most. There is a clear boundary between privacy and secrecy, and crossing it transforms a defensible structure into a problem. Privacy uses available legal tools to limit what the general public and non-entitled parties can readily see. It still satisfies tax reporting, responds to lawful processes, and maintains accurate books that reflect economic reality. Secrecy involves concealing assets, income, or control from parties entitled to that information. The IRS, courts, or known creditors. Fraudulent conveyance statutes exist specifically to unwind transfers made with intent to hinder, delay, or defraud legitimate claimants. When assets move after a problem has already surfaced, courts can reverse the transfer and impose sanctions. The strongest privacy arrangements are established before any dispute or examination exists. They are supported by contemporaneous documentation of purpose, proper funding, and accounting records that make the economics transparent to those who have a legal right to see them, while remaining difficult for casual searchers to assemble. Privacy retains its value only when it remains on the correct side of that boundary. Structures built on documented purpose, clean contemporaneous records, and consistent operations preserve capital and optionality. Arrangements that drift into concealment create the very vulnerabilities they were intended to avoid and can accelerate the loss of both wealth and strategic position. If you are building or protecting wealth and recognize that uncontrolled public exposure reduces your room to maneuver, the solution is not concealment. It is deliberate, defensible structuring supported by accounting that does not create contradictions. At Numeratus.us, we help clients design and maintain privacy layers that are legally coherent, aligned with remaining disclosure obligations, and backed by books that withstand scrutiny. Book a consultation in the description. Thanks for watching.